Well, thank you, Adam, and thank you everybody at 121 for helping me and nursemaiding me here to make sure I got here today. I'm the Chief Precious Metals Analyst for HSBC. Feel free to laugh at the last name of a precious metals analyst being steel. It gets even odder when I tell people that my father was a welder, a union welder, and my grandfather was a blacksmith. So we'll see how this goes for future generations. But after seeing our beautiful HSBC lions, which you'll see outside every head office, we'll move into the gold market. And one of the points that I want to make about gold is that it is a geopolitically led metal. Geopolitics has a great deal to impact on gold. For example, in the 1990s, we were in a profound bear market, in part because the Cold War ended and central banks realized they didn't need to keep as much gold reserves on hand. And a lot of risk came out of global markets. Risk is back in. I don't have to tell anybody here what a risky and uncertain world we live in. And the interesting thing about geopolitical risk in precious metals, however, is you can't model it. And what I can do is I can look and see what happens to gold when the Fed raises rates by 25 or 50 basis points, or when the Bank of England does it, or the ECB, or what happens when stock markets go up, or what happens when the yield curve inverts. But what I can't do is look at geopolitical events, because every single geopolitical event is different. And that's what makes it interesting. But what the World Bank and the IMF classify as a geopolitical event, more of them have happened in the past 3 years than happened in the previous 15 years. And by definition, geopolitical events are generally negative. They can be positive, such as the fall of the Berlin Wall, but generally they're negative. And so that should alert you. And we think $100 to $150 is in the price of gold because of the high level of uncertainty and geopolitical risk that we face. And we don't see it getting and we don't see it smoothing out anytime soon. Well, in addition to looking at geopolitical risk, another way of assessing what's happening in the gold market and what might happen is to look at financial conditions. Now, the simplest way, and we'll look at that too, is to look at real yields and see the impact on gold price. But a little bit more complex way is to look at financial conditions in general. And our ACE team of economists, Janet Henry and James Pomeroy, worked out this very interesting financial conditions indicator. And this goes up to the first quarter of this year, by the way. This is quarterly data. And we use things like the credit standard, the real exchange rate, high yield spread, real rates, wealth effects, et cetera, Any of you who've been subjected to any economic classes in the past will know some of these things. And you'll see here that when, for example, during COVID, financial conditions loosen, we generally get a gold rally up to the point where the market thinks they're going to tighten again. And then when we get tighter, which is below the axis, the gold market drops. Now, what's interesting is that it dropped for the first 3 quarters of us tightening and then took off again. So this shouldn't have happened. So why did it happen? Well, one of the reasons is because of extraordinarily strong physical demand. Bars, coins, central bank offtake, and jewelry. And this overwhelmed this level here. Another way of looking at this is to look at the spread, the 10-year real rate, that's minus inflationary expectations. I flipped it on its side, I inverted it so that you could see the relationship with gold. And you'll see it moves lockstep. When real rates went negative, the gold market rallied. During the global financial crisis, when they went more positive, the gold market dropped. When they went negative again with COVID, the gold market rallied. Then as they went positive again, gold dropped and then took off again. despite the fact that real yields remain very positive. Again, physical demand was very strong. Well, here's why we think physical demand is slowing, and this is one of the reasons that gold is recalibrating. If you look at 50% of all the physical gold, it's very easy if you're at HSBC or you're a big fund manager like my friend here, or you're a portfolio manager insurance company, it's very easy just to look at inflation and the interest rates and dollar and figure you've got a hold on gold. But don't forget, gold is also dominated by hundreds of millions of people around the world buying small amounts, and also by miners producing it. And a 10-gram bar, 50% of all physical gold in the world is bought in China and India. And these are very price-sensitive economies. For a lot of my recent career, a 10-gram bar, which is the most popular bar in India, was 25 to 35,000 rupees. It's about 62,000 now. It's just too expensive. Similarly with China. Gold is at an all-time high in renminbi terms. That's why the dollar is important. Gold is priced in dollars, so the stronger the dollar is, the higher it's going to be in renminbi and terms. And now we're seeing a slowing in these economies. And here's the evidence. These are monthly imports into India of bullion. And you see, as of this year, they began to really drop. Now, don't quote me on the exact number, but I do believe HSBC is responsible for about 20% of all the physical gold that goes into India comes from our vaults, and something like 25% in China. So we're a very large physical bullion house. We don't just trade it on paper. There's a big vault in the bank that I work in, and we'll send gold to you or take gold for you. Silver, platinum, palladium, anything you want. Now, what I would also mention about monetary policy, before I forget, is that the other reason we think the gold market is recalibrating slightly lower, although not significantly lower, is that we're not looking for rate cuts in the second half of the year. And this has been our policy for well over a year now. Now, much of the rally in January and February in gold was predicated on expectations that the US was headed into a recession and that inflation was going to come down very quickly. Well, inflation has come down, but not as quickly as the Fed wants it to. And there's no sign, especially given the last unemployment number, that we're heading into a recession. So if we're not going to get these two rate cuts that the Fed futures have implied that we should get in the second half of the year, then gold is going to recalibrate a bit lower. We don't think there's going to be a rate cut until the second quarter of next year. And Ryan Wang, our US economist, is very, very good at this. In my opinion, he's the second best analyst at HSBC, in fact. Modesty forbids me from saying who I think is the very best. But so this is important because if rates don't cut, if rates do not come down, and the physical market is slowing, it would imply that the gold market was right to come back below $2,000. And here's our jewelry forecast. Now, 50%, again, it's very easy if you're at a big bank or if you're a hedge fund, portfolio manager, insurance company, to think about the big macro issues. But 50% of all physical demand in gold is in jewelry. And our forecasts are for lower jewelry prices. Now, it's easier being a precious metals analyst at HSBC, because we have a big physical presence. So if you've bought some jewelry in the high street or in a mall, we may have had a hand in it either at the jewelry level, the refining, the recycling, or the mining level, either project financing or hedging for the mines, et cetera, et cetera. If you can think of a large mint for coins and bars, we may very well work with them, managing their gold, supplying them with gold, taking gold, or hedging for them. We never say whose client is who, but you can probably guess. We also have two analysts that do nothing but jewelry and luxury goods, and I can rely on them. And we are looking for lower jewelry demand this year. This again would imply some build-up in the physical market. Well, the other thing that is going to be different from this year than last year is central bank demand. Central banks were absolutely rapacious in their demand for gold in 2022, unbelievably strong. Never seen it this high. In fact, they were the biggest buyers since 1967 when Bretton Woods was collapsing and we had a hemorrhage of gold out of the United States, out of Fort Knox into the European central banks because they were presenting their dollars back and we were sending them gold. That's how Bretton Woods worked. That's how a gold standard works. Now, we believe that central banks bought about 1,136 tons of gold last year. That's over 30%. That's about 32% of physical production. I mean, think about that. Almost 1/3 of all the gold that came out of mines went into central bank vaults. Now, there's reasons for this. There's geopolitical issues, but there's also a move again out of the dollar. Now, we're not in the de-dollarization camp. We think the dollar will remain the world's reserve currency for the foreseeable future. But that doesn't mean that, and I'm just using this as an example, and don't quote me, that the Central Bank of Malaysia needs 70% of its reserves in US dollars. Maybe they want 67%. Now, when we talk to them, it becomes apparent that they may be uncomfortable moving it. They have to move into another currency. Central banks are very limited as to what they can hold. They're not allowed to hold just anything. They can't have stocks, for instance. And so maybe they don't want to hold euros. Maybe they don't want the yen. The Swissie's too small. Canadian's too small. Australian dollar's too small. Who would want sterling? But gold provides a sweet spot. You can move out of the dollar without moving into another currency. And that's why gold is attractive to these guys. We had a central bank conference in July, and every year we choose a different topic. Last year we used inflation, monetary policy, fiscal policy, blah, blah, blah. Last year HSBC chose gold. They told me 3 days before the conference, by the way, that I was speaking to central banks. And we had record attendance. We had people coming up from the embassies in Washington. I'd like to think it was to hear me, but I know it wasn't. It was the topic. And I thought, these guys must be getting ready to buy gold if they've come all the way here just to listen to me, just for one day. Now, we do think it's now too expensive and that they're going to rein back a little bit. So again, if we only have 650 tons this year, which is still a very high number historically, but not as high as last year, it's going to create some surplus on the market. Well, against this, we have increasing mine production for the next 2 years. Now, we work a lot with the mines. Some of the mines we've had relationships with for over 100 years in different incarnations of the bank. Don't forget, it's an old British bank. And so anywhere they went, particularly for mining, we're probably there. And we do believe that for the next couple of years, we're going to see more production. Now, that's not to say we're going to see more production forever. We do believe this is going to top out in the mid-20s, but right now it's increasing. But more important for supply is recycling. Recycling is far, far more, immeasurably more flexible than mine supply is. And you can mobilize and get gold onto the market in 30 to 90 days, depending upon the form that you hand it in to be recycled. We work with a lot of recyclers. Over $2,000, we estimate that 1 out of every 8 ounces of gold in the whole world is in India. And believe me, over 60,000 rupees for 10 grams compels a lot of housewives to hand gold in. And that's what we've seen. And every time we see a rally that is not sustained over the long run, it's been accompanied by a jump in recycling and a decline in jewelry demand. And it's very tempting to hand in stuff for recycling. Now, when that recycling begins to come off and the jewelry demand starts to go back up again, that can give you some parameters on the downside. This doesn't detract from gold's brilliance as a portfolio diversifier, but it gives us some ground breaks, some benchmarks that we can look for the price to move within. Gold's already had a very good run. Well, turning very quickly to silver, And so we're looking for a modest decline in the gold price. A lot of it's already happened. Our average price this year is $19.05. So looking for a little bit lower until the central banks come back in. Silver has closed the gap with gold up until recently. We're also looking for mine supply to be higher. 70% of silver mine supply, by the way, is a function of base metals and gold production, not a function of silver output. There's only 30% of silver comes from primary silver mines like Fresnillo. 70% comes from people looking for tin, lead, zinc, copper, and gold. And this is going to float silver rising. So we've still got a substantial amount of silver. Also, when silver gets to if it gets to $30, you can expect more recycling to come back onto the market. That market is also flexible as far as recycling. That's why when it got up to 50 in 2011, I mean, I'm rarely sure about things in my life, but I was pretty sure it wouldn't stay up there because we were getting massive amount of indications from recycling clients that they were flooded with silver. In fact, if anybody went across any yard sales after that, you'd have noticed there weren't a lot of silver items around flea markets. But what we are positive is not so much in the jewelry and the coin demand as in the industrial demand. 50% of all silver goes into industry. And we forecast, our economists forecast, 2% rise in global industrial production this year. But what you need silver for, photovoltaic, electric cars, environmental, biosciences, are going to rise at an above margin rate. That is to say, we're looking for industrial demand for silver to be up 5% against 2% overall industrial production. You go into a hospital, almost everything is coated with a thin coat of silver that you can't see. There's an ounce of silver in an electric car. There's half an ounce of silver in a normal petrol car. It's used in minute quantities in electronics. Nobody ever didn't make a transistor or a microchip because silver was expensive. It's relatively price inelastic, and that's why we're positive on it. The coin and bar demand, we think, will be down this year after a record high number last year, again, because inflation is falling, and the retail market is not going to be so strong. I just came from a Royal Canadian Mint conference where I spoke to nobody but coin and bar dealers, and they weren't happy to hear that. But this is what we think nonetheless. There's very often strange physical occurrences every time I speak. Things fly around the room. I often stir up bad spirits wherever I go. Now, the other thing that's interesting about silver is a decline in exchange stocks. Both London and COMEX, New York, I used to work down there, in the old World Trade Center, right on the floor, just like you see in trading places. And I was, and both stocks are falling quite rapidly, and that's because of the relative shortage of high-grade silver. Now, this will all be caught up with, but one of the things that's interesting about silver is a lot of, and again, don't quote me on them exactly, but people like Dow Chemical, people like Siemens demand 4 nines. And it's not so much that they need a purity of silver, it's what's left over when you have a 3-9 like arsenic and stuff like that messes up. So this is going to help bolster the entire silver complex. So we're looking for more like an average $25 this year. But beware of any wild rallies like during Reddit, when it got up to $30. I knew that was going to come down because, again, the recycling really started in very large measure. So we're moderately positive on the silver, especially from the recent couple of dollar sell-off. We do think the recalibration lower in gold is justified and may move a little bit lower until we see more central bank and related demand come in. But that doesn't detract from gold's brilliance as a portfolio diversifier. We still think its safe haven aspects, attributes, and its portfolio diversifying interest is going to keep it on investors' radar, but it's heavy above $2,000. It really is. Thank you, Squire.